You have a real serious warning that we are indeed, I can say you, because you live there as well, looking at a bubble in Canada, and that it will burst, and that it will cause a financial crisis.
Yes, it's a major bubble. It's 3 times the house prices from 15 years ago, which is, as far as I could tell in my research, never happens. It's happened a couple of times, and of course you experienced that in the United States with the bubble, but the bubble in Canada is actually a little bit bigger than the bubble was in the United States before it burst. So. But along with that is the personal debt level, the household debt level. So in Canada, in the private sector debt, we're at 200% of GDP. There's only about 5 countries in the whole world that have that elevated a private sector debt ratio. And that's a big warning sign for a financial crisis.
And that's something that people have been warning about for a while. Luke, when it comes to Canadian real estate, there's Toronto and Vancouver, and then there's everyone else, right? You've got inflated prices in those 2 cities, but you don't see it in Montreal and Quebec City, in Edmonton or Calgary.
Exactly. Well, you don't really see the same level of home price appreciation right now. However, some economists would argue that, just because the rate has moderated, still at a stock, it's at a very high level. And I think that's one thing with all these rule changes today that's kind of catching people off guard. These are not really targeted measures to cool Toronto and Vancouver the way Morneau's last little 500,000 change was. This one on the mortgage rules, it's really going to affect the provision of credit across the board.
But we were expecting more targeted measures, right? Can you even do that? Is that possible?
I don't really think so. I think when they actually got into it, they realized that they had to do it on a broader basis, and these measures are fairly small steps, if you like. Although it is pretty significant, like qualifying for a 5-year. It's a little bit different in Canada. You only get your fixed rate for 5 years in Canada. In the U.S., of course, it's for the whole 30 years. So, but the qualification now is going to be based on a much higher interest rate. So the young couple with, say, $100,000 in income in Canada, before could qualify, say, for a $660,000 mortgage. Now they'll only be qualifying for a $500,000 mortgage, and that's going to make it very difficult for them to buy a house. But just to correct one thing, I think that's sort of leaked into this thing is actually house prices have increased pretty well everywhere in Canada, from a lower base. But in Alberta, where I'm from, for example, house prices have tripled as well in Calgary and Edmonton.
Over 15 years.
Over 15 years.
Yeah, so a longer term view. But if we do see, although it's unfortunate for young people who want to buy, a bigger house or in a nicer neighborhood, that has to take some of the demand out of the equation, right? I mean, that has to help to deflate. Isn't it possible that we could see the housing bubble, instead of burst, like deflate in a very nice and positive way?
I always get asked about the possibility of a soft landing, and so there's 2 things to say about that. First of all, a fellow named Jeremy Grantham, who you might know in Boston, he's investigated 28 bubbles, and he didn't find a single one that had a soft landing. But also, when you think about it, a tripling of the house prices, when wages are only up probably 20%, it would take decades of flat house prices to get back to where the ratio is in line. And of course, the problem with that, with decades, is we usually have a recession every 6 or 7 years or sooner. So when the next recession comes, then the opportunity for a soft landing will be removed. So that's the issue there.
So Hilliard, we talk a lot about possible triggers for this Canadian housing burst, and you didn't write this book yesterday. Some time has happened. So we've had oil since, we have the possibility of importing higher rates from the U.S. And now more and more we have the government getting involved with the market, possibly at a later stage in this housing boom. So when you rank these triggers, what do you see as being the one that really we should be keeping our eyes on? What could really take the wind right out of the market sails?
Well, I think it's recession. Alberta is in a recession. Alberta is 20% of the Canadian GDP with 11% of the population. And the recession, people get laid off. They're a young couple with double incomes. One of them gets laid off. There's a divorce, any kind of possibility. And it only takes 5 or 10% of the houses to get into difficulty, as you discovered in the United States. And it drags all the house prices down. So I think a recession is probably the most likely thing to happen. But if banks were to discover that they were lending money to people that can't pay the money back, and they decide to change who they lend money to, that could also be a trigger. And that might be something that sort of started the process today with the changes in the rules.
C.D. Howe Institute has suggested that Canada should build a fund to cover taxpayer losses of up to $9 billion Canadian, which the government could then tap in case of mass defaults. What do you think about an approach like that? Is that feasible?
Well, there's something we haven't talked about CMHC. CMHC is unique in the world. So this is where the lenders can lend, as long as they follow the rules, they can lend as much money as they want to as many people as they want. They don't have to be particularly well qualified. You could almost call it subprime, except in Canada we're not allowed to call it subprime. And this government insurance agency insures the mortgage, not for the house buyer, but for the lender. So that is the thing that keeps it going. But if CMHC were to get into trouble, there's $500 billion of mortgages insured in CMHC. And so the numbers would be much, much, much bigger than $9 billion. It would be in the $50 billion range, probably.
Hilliard, what's the biggest risk to your forecast, to your outlook? I mean, what could save Canada?
You know, I think, like everybody says, if Donald Trump gets elected, they're all going to move to Canada. So that would probably be it.